This video covers Mitsubishi Corporation's financial results for the second quarter of fiscal year 2025, covering the period from April to September 2025. Mitsubishi Corporation is Japan's largest general trading company, also known as a Sogo Shosha. It is part of the Mitsubishi Group. Mitsubishi is one of the big three trading companies in Japan, known as Sandai Shosha, along with Itochu Corporation and Mitsui & Co. Executive summary for the first half of fiscal year 2025. Underlying operating cash flow was 446.3 billion yen, and consolidated net income was 355.8 billion yen for the 6 months ended September 30th, 2025. Both figures are generally in line with the company's full-year forecasts, although there were differences between segments due to seasonal factors and dividend timing. Mitsubishi maintains its full-year forecasts of 900 billion yen in operating cash flow and 700 billion yen in net income, while revising projections for each segment to reflect global economic conditions. During the quarter, Mitsubishi announced two important projects in its copper business. One was a joint mine plan in Chile for adjacent copper mines, and the other was an agreement to acquire shares in a U.S. copper mining project. In addition, Mitsubishi stated that it is continuing its enhanced initiatives to strengthen profitability and raise the value of all businesses under its Corporate Strategy 2027 plan. Financial summary results for the first half of fiscal year 2025. Underlying operating cash flow decreased to 446.3 billion yen, down 15% year-on-year, mainly due to weaker market conditions in the Australian steelmaking coal business and the reclassification of Lawson as an equity method affiliate. Consolidated net income was 355.8 billion yen, down 42% from the same period last year. The decline was mainly because the previous year included large capital recycling gains that did not recur this year. Despite these year-on-year drops, both operating cash flow and net income are roughly in line with the full-year forecast, showing steady progress toward the company's guidance. Mitsubishi also made strong progress in its 1 trillion yen share buyback program. By the end of September 2025, Mitsubishi had already repurchased 578.2 billion yen worth of shares. The annual net income forecast of 700 billion yen represents a 26% decrease from the previous year, but the net income progress rate against the forecast is 51%, which is in line with the plan at least. Consolidated net income by segment for the first half of FY2025, comparing results with the previous year. In the environmental energy segment, profit decreased by 9%, mainly due to higher costs from starting up production in the North American LNG business, partly offset by dividend income timing in the Asia-Pacific LNG business. The Materials Solutions segment declined 46% because of lower market prices in the North American plastic building materials business and weaker transactions in essential materials and steel products. The Mineral Resources segment dropped sharply by 79% due to the absence of last year's large gains from the sale of 2 steelmaking coal mines and lower coal and iron ore prices, as well as increased costs. In contrast, the Urban Development and Infrastructure segment rose significantly, driven by the absence of last year's impairments and losses in the North American real estate business and gains from energy infrastructure projects. The Mobility segment fell by 30%, affected by market headwinds and higher U.S. tariffs in the automotive business. The Food Industry segment declined by 44%, because last year included major gains from the sale of KFC Holdings Japan and Prince's, UK-based food and drink company. This year saw a smaller gain from the sale of TH Foods, US snack manufacturer. The Smart Life Creation segment dropped significantly by 69%, as last year included large revaluation gains from the reclassification of Lawson as an equity method affiliate. The Power Solutions segment increased, supported by higher capital recycling gains in Japan's power business and stronger earnings in the European integrated energy business. Overall, consolidated net income was 355.8 billion yen, down 42% year-on-year, reflecting the lack of one-time gains recorded in FY 2024. Key investment projects announced during the first and second quarter of FY 2025 under its Corporate Strategy 2027, which focuses on the themes of reshape, create, and enhance. Projects announced in the first quarter. These include the LNG Canada project, which shipped its first cargo and is expected to expand production, an investment in a biofuel production and sales business, the acquisition of 3 salmon farming businesses by Cermaq to strengthen the marine products portfolio, and the tender offer for Mitsubishi Shokuhin, completed in FY2025, to enhance profitability in the food distribution business. In the copper business, Mitsubishi announced 2 major initiatives. The first is a joint mine plan in Chile with adjacent copper mines. This Reshape project aims to optimize development and increase efficiency, with production expected to begin around FY2030. The plan requires only limited additional capital investment, but will raise annual copper output by about 12,000 metric tons on an equity basis compared with standalone operations. The second project is a U.S. copper mining investment under the Create category. Mitsubishi agreed to acquire shares in the project for 61 billion yen, with an additional 26 billion yen in development costs. Production is expected to start around FY2029, increasing Mitsubishi's annual copper output by about 30,000 metric tons on an equity basis. Together, these projects demonstrate Mitsubishi's strategy to expand its resource base, develop next-generation energy solutions, and strengthen earnings through strategic investments that align with the company's long-term growth vision for 2027. Enhance initiatives under Corporate Strategy 2027, which aim to strengthen the company's earnings base and increase the value of existing businesses through operational improvements, digital transformation, and portfolio optimization. In the marine products business, Mitsubishi is enhancing productivity and adding value by improving processing capabilities. Its subsidiary Cermaq agreed to acquire 3 salmon farming businesses from Grieg Seafood. This move will expand production volume and boost efficiency through Cermaq's aquaculture expertise. In the ASEAN automotive business, Mitsubishi is focusing on market-oriented product planning and expanding its value chain. In Indonesia, Mitsubishi launched a new midsize SUV tailored to local needs, achieving strong demand. Mitsubishi is also using AI-driven digital marketing to reach potential customers more efficiently and improve sales activities. In the steel products and essential materials business, Mitsubishi is reorganizing operations to improve efficiency and profitability. It is restructuring its wire and specialty steel businesses and implementing growth strategies for the silica sand and other essential materials operations. In the food distribution and retail business, Mitsubishi is using AI and data analytics to improve profitability and optimize operations. At Lawson, collaboration with KDDI has boosted daily sales through AI-based demand forecasting and improved promotions. At Mitsubishi Shokuhin, data-driven product development is helping strengthen competitiveness. In natural resources, key initiatives include stabilizing operations and restoring production in the steelmaking coal business, targeting recovery to 43 to 45 million tons per year by FY2027. In the LNG business, the LNG Canada project shipped its first cargo in June and plans to start production at Train 2 in November. Overall, these initiatives show steady progress toward building a stronger and more resilient profit base across Mitsubishi's major businesses. Shareholder return policy under Corporate Strategy 2027. Mitsubishi's policy emphasizes progressive dividends and flexible share buybacks while maintaining financial soundness. The dividend per share for FY 2025 was increased from 100 yen to 110 yen. Mitsubishi plans to continue raising dividends gradually in line with profit and cash flow improvements, assessing each increase carefully based on financial conditions. Regarding share buybacks, Mitsubishi will flexibly decide whether to allocate excess cash to further investments or additional shareholder returns, depending on available opportunities and capital needs. The ongoing 1 trillion yen share buyback program is part of this approach. Under Corporate Strategy 2027, the 3-year average total payout ratio for FY25 to FY2027 is expected to exceed 40%, which is higher than the target set in the previous midterm plan. Although Mitsubishi has not set a new specific payout ratio target for CS 2027, it aims to maintain this strong level of shareholder returns. The company's strategy is to balance steady returns to shareholders with investment for future growth. Overall, Mitsubishi continues to focus on sustainable value creation for shareholders through a combination of dividends and share repurchases. Stock price. This chart over the past year shows the stock price in Japanese yen at 3,568 as of November 4. This chart shows the stock price in US dollars at 24.03 as of November 3. After the earnings announcement, the stock price fell more than 3%. Current PBR is 1.51 and PER is 19.2. Dividend yield is 3.08%. Compared with historical PBR, PER, and dividend yield, these figures suggest that the stock price is relatively high. The earnings results might not have fully met market consensus and the stock price declined today. However, a few years ago, Mitsubishi stock was much cheaper, so it is still relatively high compared to back then. Conclusion. Mitsubishi Corporation's first half results for FY2025 were generally in line with its full-year plan, though profits declined 42% from last year. Mitsubishi continues to advance major copper, LNG, and biofuel projects, aiming to build a stronger and more resilient earnings base. While its annual forecast remains unchanged, Mitsubishi is maintaining steady shareholder returns through higher dividends and a large-scale buyback program, reflecting its commitment to both financial stability and long-term growth.